Hey, welcome back to the Tater Talk podcast. Today I'm joined by Marty Abbott, founder and president of the Incentive Management Group. Marty, good to see you. Thanks for coming.
Yeah, good to be here. Looking forward to it.
So, Incentive Management Group, I understand also like this is like your 30th year in business, right? But
Yeah.
so tell us about Incentive Management Group, and then I'm really interested for our listeners to learn more about what it is you do.
So we are a company that has the capability to help a client to reduce their investment costs by up to 15%, usually between 7 and 15%. And we do that by seeking, on their behalf, incentives from state, county, and local governments. And those incentives are all sorts of various financial benefits. They can be outright grants, they can be cost offsets, they can be paid for services, they can be tax credits, and so forth. And we do three things. We identify a strategy to pursue those when there's a multi state consideration, which is normal. And then we go out and get the incentives, which is a 3 to 6 month period of time. And then we manage the incentives over a 18-year period of time, 18-20 year period of time. And that last piece is very important because most companies will begin to drop the ball at the 3 to 4 year period of time. And if you don't do the reporting properly, there can be clawback provisions and you can, lose some of the benefits that you initially negotiated.
Okay, got it. So I'm sure people are wondering, well, what does this have to do with potatoes or potato
Yeah.
processing or the potato industry? But in fact, that's how you and I met several years
Yes.
ago, right?
Yes.
So, so I think it might help to, and you can name names or not.
Sure.
It might help to like walk through a really particular example to help
Yeah.
explain
Yeah.
and communicate what it is what you offer and how it benefits potential potato processors, right?
Sure. The process that we use is almost always the same and very close to being the same, and it's the three stages. As I mentioned in my opening introduction to the IM group, we identify the incentives that are possible and a strategy to achieve those. We then go into the marketplace and obtain the incentives. That comes in the form of offer letters from state, county, and local governments, and then we manage the process. So to use one of our best examples and one that in the potato industry should be very recognizable. We did a project in 2017, 2018 for McCain Foods that expanded, as everybody in the industry knows, expanded their Burley, Idaho facility, adding about 165 jobs and investing over 250 million. All of that's public knowledge. So that project started probably 18 months beforehand as we were working with engineers and designers and so forth. We came up with some very preliminary estimates of the cost savings that we could put into effect. And if I recall correctly, the forecast was for 18 million of incentives. That is pretty accurate. It's 18.5 million. And over the course of the design phase and the evolution of the project before it launched as a construction project, we were updated with the investment changes and personnel changes and all of that kind of stuff. So we made adjustments to our plan. We were competing with a Canadian option and one North American option that probably wasn't as viable as the Canadian option. And and so we always were identifying what the internal rate of return is, which is what McCain uses for its analysis and financial analysis primarily.
So, Marty, when you say you were competing in these other
Yeah.
options, what you mean is like dig into that a little bit more. What was in competition there?
So the what we were advised is that McCain had an option for a Canadian expansion to achieve the same volume as the Burley expansion.
Hmm.
And we did not have responsibility for Canadian incentives. So we were simply obtaining them for Burley and being knowledgeable about what was happening in Canada.
So
What's typical?
go ahead.
Yeah, what's typical for us is to be given responsibility for all of the options, and we might start off with 5 states, narrow it to 2 to 3 states, and then get incentives from all of those states. There's 2 strategies you can use. Both are legally necessary, or one is legally necessary, one or the other. And the first one is, if you are talking with a state, you have to basically say to them that there is another state that is competing for this project,
Mm,
or you have to indicate that the rate of return that is being achieved is not sufficient to move the project forward, and without the incentives, the project would not move forward. Either one of those 2 approaches is legally gets you into the negotiated incentives field. There's 2 kinds of incentives very broadly, and I don't want to dig in too deep, but one is statutory, which are available to everybody. You simply fill out a form and you get those. The other is negotiated incentives, or known sometimes as discretionary incentives. Those are the ones that we work on. Those are the ones we get paid the money for. And those are the ones that get you the $18 million, the estimated $18 million that we've put together for McCain. So those are the ones that you're going to be talking with the states about and competing on.
okay, so a business, a manufacturer specifically is who you work with, right? Different
Yeah,
manufacturers. They're looking at viable options for where they may invest,
right.
and you're helping evaluate the incentive programs that are that they could capture different incentives from those different jurisdictions, and then you help identify those, and then and guide the manufacturer through, what is possible in these different jurisdictions.
Yeah,
Is that correct?
yeah, and we have I wouldn't say it's totally unique, but we have a capability that we've developed over the years, because I've been doing this for more than 25 years. We have the capability to forecast within probably 5 to 10% the level of incentives that we will actually achieve. And we do
Mm.
that before the project starts. It takes us 2 to 4 weeks to put together that analysis, and we lay out for our clients every single incentive by type, by year of impact, whether it's a balance sheet item or an income statement item, and so forth. So it's a very detailed look before we even go into the marketplace of what the incentives are in the various states that are in competition.
Gotcha. Okay. So I took you down that rabbit hole about the competition, but you were saying with the McCain example, you were looking at these
Yeah.
maybe 3 different options. Yeah.
Yeah, so with McCain, we did our $18.5 million forecast. We laid out everything, and then we went into the field. That's the term that I use. We went into the field and had discussions with state, county, and local governments. In McCain's case, because we've been with McCain since 2008, we had pretty close to 100% responsibility for all of the work and all of the discussions. We had some presentations that were made by McCain, but it was our work, including working with the legal team that McCain hired in state, to put together the entire program, all of the documentation, and so forth. So it was about a 9-month period of time to begin the discussions, and then get the final incentive tied down, go to McCain with the full package, the 9 months developed package of incentives, which, by the way, turned out to be $26.6 million, and get McCain's approval to the project. We make a presentation usually 2 to 4 weeks before a board meeting. That board meeting takes all of those numbers and makes the final decision. And that is a critical point, because in planning, we need 3 months ideally to 6 months ideally. 3 months is a little tight in some cases, but that's the period of time it takes us to put together all of the work, all of the documentation, get the state, county, and local governments to do their legally required notifications and so forth. And then you can go to the board get the approval, and everything's legal at that stage.
Gotcha. 26 million dollars on a projected $250 million project. That is extremely significant. Uh, so, I mean, if McCain hadn't engaged you, there's a chance that they may not have been able to, uncover and avail those incentives. So, um,
Yeah,
in your
we
experience,
yeah, go
do you
ahead.
think do you think
Yeah,
companies are underutilizing this access to incentives?
when we come into a company that has not used a professional capability like ours, what we find is that they're getting about 30% of the available incentives
Wow.
that are out there.
Hmm.
And that's at the stage of obtaining the incentives. And then when you get into the stage of utilizing the incentives, there's anecdotal evidence. It isn't very well documented, but there's anecdotal evidence that companies on their own utilize 50% of the incentives that are available. We get paid 50% of our fees for ensuring that the company is using 100%. We probably get above 95% on all of our projects. So, when you combine the underutilization at the obtaining incentives level phase period of time, that when you're putting all the offer letters together, and then you put together the 50% underutilization companies on their own, there's a massive difference.
That is a massive difference. That seems like a huge ROI for engaging your expertise. Um, are you able to share like a level of ROI that your clients typically see from having engaged you, like after considering your fees?
Our fees are going to range at the high side, they're going to range at 20% of the incentives values. That's for
Mm-hmm.
small companies, for small projects.
Mm-hmm.
Most of the time, we're dealing in probably the 10 to 15% range. So if you look at the underutilization at both the obtaining incentives phase and then the underutilization using the incentives, it's a massive number. I mean, it's multiple, multiple, multiple. So I mean, the easy way to think about it is if our fees are, let's say, 15%, then one out of every $7 is going to come to us indirectly. It doesn't actually come to us. And so we've got to perform 15, 20% better. And that's really easy by comparison because, I mean, it's a very, we're not tooting our horn too much here because we simply focus on this, and companies on their own probably don't do an expansion project, but maybe every 3 years if it's a
Mm-hmm.
really fast expanding company. So the level of experience internally is pretty small.
Yeah. Yeah. Just there's not a lot of reps there in working through these incentive opportunities, right? So
Yeah,
let's
no, because to give you a sense of the level of repetition and the level of volume over the last 7 years, we've handled for our clients investments in expansions of $1.2 billion
Mm.
with incentives that we achieved of $90 million. So there's a
Wow.
lot of experience that's developed every year and every 7 years and so forth. And we've been now in business for 28 years plus. So lot of experience to maximize the ROI of our clients' projects.
Who are some of your ideal clients, Marty? Like
Manufacturing
without
is
mentioning names, if you're able to, that's fine.
Yeah,
Yeah.
manufacturing is important from our standpoint. We have probably done 80% of our expansion projects for manufacturers. And the reason that we focus on that is that manufacturers, by the nature of their business, have to have massive investments in property, plant, and equipment. And the states love those investments because they mean that absent some kind of disaster, the company is going to be operating for 20 to 30 years with that
Hmm.
same with most of the initial investment. The big
Hmm.
equipment's going to be there for that period of time and so forth. So they like the assurance that that gives them on the investments that they're making in the company.
Gotcha. The capital investment and expansion incentives aren't the only incentives that you target, correct? We've talked about like a training incentive program
Yeah.
that you've been developing and successful at recently too.
Yes.
So
Yeah.
I think it'd be great for people to learn about that too.
Yes, I got into this business because of a company that was in a unique situation, and we ended up getting most of the incentives to qualify for a package that they had been promised. I'm being very obscure right now. Let me get into the specifics of it. American Standard back in 1996 moved their world headquarters from New York City to New Jersey. Prior to moving, they had an offer from the governor of New Jersey that said that if you move your corporate headquarters, it was a world headquarters, to New Jersey would provide $10 million worth of incentives. They never acted on it. They moved and they never had any conversations with the state of New Jersey. And so I'm not knowledgeable about incentives. I don't even know that this business existed. So I go to the VP of Government Affairs office one day, and he gives me a letter that was written by the governor saying $10 million, move your world headquarters. And he said, go to New Jersey, state capital, Trenton, and get the $10 million. I mean, that was a simple story. So the answer to how I got into this business and how this whole process works is 3 years later, 10 million in New Jersey, 10 million around the country here in the United States. And I'm in a business that I just didn't understand before.
Mm-hmm. Quick pause to share that this episode is brought to you by Projects Consultants, a team of engineers, designers, project managers, and operations experts helping potato processors worldwide maximize the value of every dollar and every spud. Learn more at projectsconsultants.com. That's PROJEX consultants.com.
I didn't realize it existed, and I'm helping American Standard tremendously. We were able to get in New Jersey because they had 4 businesses in New Jersey. We were able to get $10 million of training funds over a period of years. And that was my first incentive type. Learned a lot about that. And over the years, we think we have gotten somewhere in excess of $35-40 million to offset training costs for corporations. Most of that has come about because of the lean initiatives here in the United States over that period of time. Those activities, Kaizen events, anything that's in the lean category, usually we can get 50% of the consultant's cost to be offset. So that's really the bread and butter of the training grants that we've done over the years. But interestingly, on the McCain project, where we had the $250 million total incentive package, we got $10 million of training funds for McCain, which is a massive amount of training money.
Yeah, that's a huge amount of training. Is there, in your experience, is there certain numbers of employees requiring training or a certain value of training where it makes sense to engage you to try and capture some of those training incentives? Like, is it 50 people? Is it a certain size of company or a certain amount of training?
That's a good question because it comes up very frequently when we're having conversations with prospects. The numbers that we use are as follows. If you're doing training, we want you to be training about 150 people. And so that maybe the company location employs a total of about 200 people. Anything smaller than that, it's got to be a pretty intense program in order to generate the dollars that we think makes it worthwhile for the company and for us.
Great.
With regard to the expansion projects, the minimum amount that we need, minimum number of new jobs that we need is 30, 10 per year over 3 years, or 30 all at once, doesn't make any difference. But with that level of project, with that level of growth in people, we can get a decent offer. And in that particular case, that offer is going to come pretty easily and very efficiently for us, so we can handle that kind of project and make some money.
Okay. Um, just to go back to some of the expansion work that you help with, um, what about in the situation with a complete new startup business that's, say, investing 60 or $70 million in their very first manufacturing facility? And that involves not only the capital investment, but a bunch of new people that will need training on the new process and training in general about how to, get that business off the ground.
Yeah, it's basically for us. It's the same project as a McCain expansion.
Mm-hmm.
165 people being added. We focus on the 165 and the investment related to that. If it's a startup and they're adding 60 or 165 jobs with an investment, that's the project. And everything that we could do for a McCain in an expansion, we can also do for a startup. The difficulty with some startup situations is that is timing. We are often not given enough time to get involved to do things properly, and it's all related to legal considerations. We have to get the incentive offers, present those to the company, and then the company makes the final decision as to location and moving the project forward. So getting in at the early design phase, the earliest, that people are thinking. What we advise clients is that if you've got a timetable, even if it's rough, and you've got a team that you've assembled, then we should be involved. Prior to that, we don't need to be involved. But when it gets serious enough that you've said, okay, we want to be in the market, meaning we want the operation to be operational in the fall of 2028. If that's the timetable and you've got a team of maybe 4 disciplines in the company that have been assigned, we need to be one of the disciplines that's added to that team.
And then at that point, you have to be able to legitimately evaluate different regions or locations to be able to assess what incentives are available.
Yeah, I mean, we could get involved a little bit later than that, but if you want to maximize the monies that's going to come in from state, county, and local governments, if you want to maximize the incentives, then we're very efficient in working with a team and understanding, giving them some options. Sometimes there's ways to have equipment or the investments vary between categories based upon what the incentive packages could be. Sometimes there are ways to get the state to pay for certain expenses if there's enough lead time provided so that they can get the legislation done and things legally put in place and so forth to meet your timetable. So there's a lot of benefit. I'd say maybe 10 to 15% improvement in the outcome by getting us involved early. And it doesn't cost anymore. Our fees are not based upon the time we spend. They're based upon the percentage of the funds that we bring in.
Gotcha. So looking into 2026, where in the United States is what's the the incentive climate look like in 2026 in the United States? Is there different regions that are maybe more aggressively pursuing manufacturers and their investments?
I'd say the climate remains pretty much the same. One of the benefits of the incentive field, at least from the standpoint of an operator like us, is that the programs remain fairly constant, the monies remain fairly constant, and there's not a lot of shift of personnel as well. it's important to understand from a monetary standpoint how incentives work. This is not understood very well by most people, but unlike most state expenditures, the incentives that are provided mostly are not expenses that hit the books and have to be approved in advance, budgeted, and so forth. So how does that work? The way it works is that the state legislation in the states provides the folks that do economic development to offer a portion of the future stream of revenue, taxes, that come in from those projects as incentives to companies. So as opposed to a budgeted amount, for instance, some of the incentives are going to be 10 years out. There's no budget planning for that. But if there's $50 million of incentives that are offered, there are likely going to be, maybe 500 million of taxes that are going to be generated by that project.
Gotcha.
And the states, the number that we use is that anything between 5 and 10% of the taxes that are generated would be a good incentive package. So the states are going to retain, 90 to 95% of the tax streams that come in. And those are individual taxes, corporate taxes, taxes from people who benefit from this expansion and so forth. Those economic analysis sometimes can be done formally. We do them now and then in a formal basis. Most of the time we do a back of the envelope calculation. What's the tax stream that's going to be forthcoming from this project? What's the value of that? What's 5 to 10% of that? That's a number that we ought to be thinking about as an incentive number that we can capture. Now, the programs don't always tie out directly to that kind of thinking, but that's the kind of thinking. So, the benefit of the process and the structure of the incentives being a future stream of taxes is there's a lot of negotiating that's involved. We will argue that this project is going to have a lot of follow-on tax benefit and a larger stream of taxes that the state could get. And then there's the negotiation of, do we get 5% of the tax stream or do we get 10% of the so our job is important to understand all of that and negotiate the best package that we can for our clients.
Gotcha. So a slight shift here because, thinking through the job creation aspects that you mentioned earlier, if a manufacturer is, say, investing heavily in automation that may actually reduce headcount for whatever reason,
sure,
does that restrict the ability to obtain incentives in a way they may be tied to headcount or like new jobs creation?
It's a very topical, very valid question. So historically, the job creation in most states was the driver of the incentive value. So, add 30 jobs and get $300,000 worth of incentives. It was fairly arithmetic. As we've moved into this changing period of time, the states are now thinking, all right, let's say that we get 30 new jobs, but we're going to lose some jobs, 30 new positions in the company, but we're going to lose some jobs. So the net number of jobs is maybe 10. Whereas in the history of the incentives, we wouldn't be able to get any incentives for that project. Now the states are saying to themselves, well, if we're getting, a huge investment and we're getting few jobs and we're not losing that many jobs, maybe that tax stream that we create these incentives out of is not going to be too bad. And so the ability of the state to offer incentives under that circumstance is now being thought more seriously about. Whereas in the past, if you didn't have a certain threshold of jobs, you just weren't going to qualify. But we're expecting that we will see over the next 5 years projects that will have no increase in jobs, significant capital investment, no increase in jobs at the facility that is the expansion facility. But because of the investment and because of the kind of jobs that are being retained, and I'll explain that in a minute, we're likely to see some significant incentives. One of the things that's happening is that, and this is happening right now with a client of ours, the average wage in the company, because of the robotic nature of the equipment that's being brought in this expansion, the average wages are going up. And so while there are no new jobs created, there's new wage monies that are being created in the state. So that's one of the things that's happening that's a positive in many of these expansions. It's not simply cutting the number of jobs, it's increasing the wages of the existing workforce.
Yeah, that's a great point. So what I hear is that manufacturers out there, and in our world, it's
Yep.
the potato industry. Now, what I hear is that if there's expansion under consideration, is that the rules and the criteria are changing. So they should probably talk to you or somebody like you and
Yeah.
understand what that incentive climate is.
Yeah.
And I know because of our conversations in the past too, Marty, that, and thank you for sharing the story about McCain, but the work with McCain, I think precludes you from working for other French fry processors. But in our world, there's potato processing that includes, potato chips, dehydrates and other products, and maybe big fresh pack sheds or something like that expanding. There's lots of, I guess, similar or adjacent opportunities for our audience to consider
Sure.
as well.
Yeah. Yeah. In McCain's case, we have very specific non-compete companies. It's not the world. It's the obvious big guys.
Gotcha. Yep.
But if you're a startup in the potato industry, more than likely you're not on that list. Or if you're even a mid-sized company, more than likely you're not on that list.
Yep. And I mean, our audience is growing, and it's pretty broad. So there's a good chance that somebody outside the potato industry is going to hear this, or
Yeah.
from the potato processing side. It could be something that serves the industry, a big
Sure.
manufacturer or something like that as well. Equipment manufacturer. Well, that's really enlightening, Marty, about how that all works. I guess to kind of put a bow on it, what would you like to leave with manufacturing leaders if you could leave kind of one big point?
The biggest missed opportunity, both for us financially, but also for our clients in terms of the financial benefit to them, is not getting in touch with us early enough. As I indicated, we don't charge by the hour, and so the earlier we're involved, the higher the return to the client, and our fees are based solely upon the percentage of incentives that we bring in. But there's so many missed opportunities. It's sad to say from our standpoint, and it's sad to say from company standpoint, but now and then we get a call and it's just too late to begin any negotiations. Companies don't realize that they have the opportunity to get these incentives, and the magnitude of the internal rate of return increase from the incentives is such that it's just crazy not to get somebody like ourselves involved, come up with a strategy that works, and take advantage of a relationship with the state government that makes an awful lot of sense for everybody.
All right. So for those considering expansion or have identified a training program opportunity, they need to talk to you early. Yep.
Yeah, there's no cost. There's no cost for the early conversations.
Yep.
Obviously, those are just part of doing business.
That's great. So how do people find you, Marty?
We're LinkedIn is probably where almost everybody would be able to see us within 30 seconds of thinking about that,
Hmm.
and our website's the second, probably the best opportunity. And if they talk to you, Mike, or anybody else that's in the field of supporting uh, expansions as we are, we're a great resource to bring in as part of a team to help the client.
Excellent. Well, Marty, thank you very much for spending some time on the podcast today. And it was I sure it was helpful for me, and I know it'll be helpful to our listeners. So thank you very much.
Thanks for having me, Mike.